Are you looking for a way to grow your money but don't know where to start? Mutual funds could be a great option for beginners. Let's break it down so it's easy to understand. A mutual fund is like a big pot where lots of people put their money together. This pot of money is then used to buy a mix of different investments, like stocks, shares in companies, or bonds, loans to companies or the government. Instead of choosing what to buy yourself, a professional manages the fund for you, spreading out the risk by investing in a bunch of different things. This way, if one investment doesn't do well, others in the fund might still perform well and balance things out. For example, imagine you put $1,000 into a mutual fund. The fund might use that money to buy shares of 50 different companies and a few government bonds. If one company's stock drops, the other investments might still do well, helping to protect your overall investment. There are different types of mutual funds to suit various needs. Stock funds. These invest mostly in stocks or pieces of companies. They aim to grow your money over time but can be riskier. For instance, if you invest in a tech stock fund, you might see significant growth if tech companies perform well, but there could also be big drops if the tech sector faces challenges. Bond funds. These invest in bonds, which are like loans made to companies or governments. They are less risky than stocks, but the returns, how much money you make, are usually lower. For example, if you invest in a government bond fund, you might earn steady interest payments with less risk, but the growth potential is lower compared to stock funds. Money market funds. These are very safe and invest in short-term loans. They don't offer high returns, but they protect your money and let you get it back quickly if you need it. For instance, if you put money in a money market fund, it's like having a savings account with a bit more interest, but your principal is protected. Balanced funds. These invest in both stocks and bonds, giving you a mix of growth and safety. For example, a balanced fund might invest 60% in stocks and 40% in bonds. This way, you get some growth potential from the stocks and some stability from the bonds. Index funds. These don't try to pick the best stocks or bonds but instead copy the performance of a group of investments, like the top 500 companies in the stock market. They have lower fees because there's not much active management involved. For example, an S&P 500 index fund will track the performance of the 500 largest US companies, offering broad market exposure at a low cost. When you invest in a mutual fund, you buy shares, which represent your part of the fund. The value of these shares goes up or down based on how well the investments in the fund are doing. The fund manager is the expert who decides what to buy and sell to make the fund perform better. For instance, if the fund is holding a mix of stocks and bonds, the manager might decide to buy more of a particular stock if they believe it will perform well, or sell some bonds if interest rates are expected to rise. So why should you consider investing in mutual funds? First, they offer diversification, which means spreading your money across many investments. This lowers the chance of losing everything if one investment doesn't do well. For example, if you invest in a mutual fund that holds shares in 50 companies, a drop in one stock is less likely to affect your overall investment significantly. Second, you get professional management. Experts handle the hard work of picking investments for you. They use their knowledge and tools to make informed decisions, saving you time and effort. Third, mutual funds are easy to buy and sell. You can quickly turn your investment into cash if you need it, usually at the end of the trading day based on the fund's value. This liquidity is convenient if you need access to your money. You also don't need a lot of money to get started. Mutual funds are affordable, with some letting you start with just a few $100s. For instance, many funds have minimum investment amounts ranging from $500 to $3,000. However, it's important to be aware of the risks. Your returns depend on the overall market, so if the stock market drops, the value of your mutual fund can also go down. For example, during a market downturn, your fund's value might decrease along with the broader market. Funds also charge fees, which are usually a small percentage of your investment. These fees can reduce your overall returns. For example, a fund with a 1% fee might seem small, but over many years, it can add up and affect your returns. Just because a fund has done well in the past doesn't mean it will continue to do so in the future. It's important to research and understand a fund's strategy and management before investing. To choose the right mutual fund, think about your goals. Are you saving for something in the short term, like a vacation, or for something long term, like retirement? For long-term goals, stock or balanced funds might be suitable due to their growth potential. For short-term needs, bond or money market funds might be better due to their stability. Next, consider how much risk you're comfortable with. Are you okay with seeing your investment go up and down a lot, or would you prefer more stable returns? For example, if you're nervous about market swings, a bond or money market fund might be more appropriate. Check the fees of the funds you're interested in. Lower fees mean more of your money stays invested and can grow over time. Look for funds with expense ratios below 1%, especially if you plan to hold them for a long time. Review the fund's past performance, but remember it doesn't guarantee future results. Look at how the fund has performed over several years, not just the past year or so. Lastly, evaluate the fund manager's track record. A manager with a strong history of making good investment decisions can be a good indicator of a well-managed fund. Once you've chosen a mutual fund, it's easy to invest. Open an account with a broker, or even online, pick the fund that matches your goals, and start with as little as a few $100s. Many platforms allow you to automate your investments, making it even easier to build your savings over time. In summary, mutual funds can be a fantastic way to grow your money. They offer diversification, professional management, and accessibility. By understanding how they work, the different types available, and the risks involved, you can make informed choices and confidently work towards your financial goals. Thanks for watching. If you found this video helpful, be sure to like it and subscribe for more easy-to-understand tips on managing your money.